I'm Roger Montgomery and welcome to this week's Video Insight. Today I want to connect two threads that on the surface seem unrelated, one from the hallways of the US Federal Reserve and the other from the cracked asphalt of the used car lots in the United States. Combined, I'm wondering if they form a single elegant warning that the equity bull market is running on thinning fumes. Jerome Powell, in his address to the National Association for Business Economics back on October 14, he floated a phrase that sent all the algos scrambling. Quantitative tightening is, quote, coming into view, end quote, for an end. The reflexive read was more liquidity, higher multiples, party on, and it lifted the S&P 0.5% before the close of that day. But I wonder whether more sophisticated capital has paused and reflected. You see, ending QT is not the same as restarting QE. Since June 22, the Fed has allowed $95 billion a month to roll off its balance sheet, shrinking it from $9 trillion to $6.6 trillion. That runoff was meant to drain reserves, push private buyers to absorb treasury supply, and tighten financial conditions in parallel with rate hikes. Yet equities have kept climbing. Why? Because the Fed never truly removed liquidity. Reverse repo facilities, overnight lending windows, and treasury bill purchases disguised as technical adjustments kept the spigot open. But what if those backdoor injections are now exhausted? Bank reserves sit at 10 to 11% of GDP, near the Fed's own ample threshold articulated by Governor Waller. Powell's pivot then is not the dovish gift it might seem to be. When QT stops, some analysts expect the Treasury to flood the system with short-term bills to fund defence, AI capex, strategic resource acquisitions and fiscal priorities. And if they're right, that's not market support. Liquidity would be more targeted, not sprayed everywhere. And banks, already nursing loan write-offs like Zion's Bank Corp, which was down 13% in a single session recently, will hoard reserves rather than lend to leveraged corporates. If that happens, credit availability shrinks. Earnings multiples compress. That 20 plus PE on the S&P becomes even more difficult to sustain. And if fiscal issuances push long-end yields higher while the Fed caps the front end to avoid 2019-style repo spasms, we get a steeper curve at the price of thinner risk appetite. In that case, gold's recent surge isn't esoteric nostalgia, it's a stress gauge. The equity market has climbed a wall of worry for 3 years thanks to AI euphoria, robust earnings, liquidity camouflage and other things. That wall is now vertical, but the Fed is pivoting from tightening to targeted support that might bypass support for the most expensive equities. And meanwhile, as recent cracks in US auto loans show, consumer resilience as measured by 60-day delinquencies is deteriorating. Subprime auto loan delinquencies have soared to record highs. Primalend Capital Partners, a key player in the buy here, pay here auto financing market, filed for Chapter 11 bankruptcy protection. Veteran short seller Jim Chanos says there's lots of red flags at Carvana, a major online used car retailer in the US. And the Bank of England's Governor Andrew Bailey has drawn parallels to the 2008 financial crisis, citing the resurgence of slicing and dicing of capital loan structures in private credit markets and describing the collapses of US companies First Brands and Tricolour as, quote, canaries in the coal mine, end quote. Now, investing isn't about being all in or all out. It's about rebalancing regularly, looking at those assets in your portfolio that have served you very well over the last few years and reweighting or shaping your portfolio to reflect your risk profile and ongoing needs. Rebalancing is not capitulation. It's capital preservation with optionality. What are some of the options? Well, one is to rotate profits from high beta growth into defensive cash flow compounders like utilities and healthcare, which have outperformed in the past month for a reason. Small caps have also started to outperform. You could also have some cash or near cash as dry powder should volatility throw up a few options. And you could add uncorrelated private assets or arbitrage funds to your portfolio. We offer a few worth considering, or at least asking your advisor to do so. Well, that's all we have time for. I'll see you again next week. In the meantime, follow our daily blogs or follow us on Facebook and X.